I want to tell you about one of our clients who we recently engaged, David. David runs a small construction company, 8 years in the business and consistently quite profitable. He's not careless with money, he's not someone who cuts corners as well. But one day he wanted to reward himself and he decided that, okay, I'm gonna buy a luxury BMW under his company, which he uses for both business and personal use without consulting with anyone. He thought it would just be a business purchase. He did exactly what most business owners would do. When we saw his vehicle purchase, I gave him a call straight away and said, hey David, I need to walk you through something you did. Your car that you just bought, it is going to trigger a fringe benefit tax liability in your company now that you bought a vehicle under a company structure. There was a silence on the other end of the line, of course. He's been in a business for 8 years. He's never heard of what the heck is fringe benefits tax. And this wasn't because he was doing anything wrong, it's because nobody had ever explained it to him. This is what inspired this video for us making, because David is not the exception, he's the rule. So today, I'm going to make sure you never get that phone call from your accountant. Hey, welcome back. I'm Molly, founder of Above Advisory and a certified tax accountant with over 15 years helping business owners legally reduce tax and actually build long-term wealth. If you are a business owner who has a company vehicle, pays for staff benefits, or sometimes you might accidentally put through personal expenses through your business, this video is specifically for you. By the end of this video, you know exactly what fringe benefit tax is, how it's calculated, where businesses get blindsided, and most importantly, how to stay ahead of it. So let's get into it. So what actually is fringe benefit tax? Here's the simplest way to put it through. ATO knows that some employers, especially business owners, can get creative. So instead of paying yourself or your staff a salary, you might think, what if I just pay for things instead? A car here, a phone there, a few nice dinners here and there. Fringe benefit tax exists to close that loophole. It's the tax paid by the employer, which is typically your business, when you provide any non-cash benefits to your employees because of their employment. And yes, if you are a director of your own company, that also includes you as well. It does not apply to wages or salary. It only applies to what the ATO calls fringe benefits. So things like company cars used for private driving, entertainment expenses, dinners, parties, events, low-interest loans from the business, accommodation paid by the business, or personal expenses run through the company. Now, here's the part that catches most people off guard. Fringe benefit tax, FBT, is not cheap. The rate can be as high as 47% tax. That's the highest marginal tax rate in the country as well, by design, because the system is built to make sure nobody gets an unfair advantage by swapping salary for perks. So let's walk through the numbers so that you understand how fringe benefit tax is calculated. FBT is calculated in 3 simple steps. Step 1, you have to work out the taxable value of the benefit. This is essentially what the private use of the benefit worth in dollar terms. Step 2, apply what's called a gross up rate. There are 2 of these. If your business is registered with GST and claim the GST credits on your benefit, you use type 1 rate, which is 2.0802. If you can't claim GST credits, then you use the type 2 rate, which is 1.8868. The gross up exists to the level of the playing field to make the benefit comparable to what it would actually cost if it were paid as salary. Step 3, then you multiply that with 47% tax rate. Let me walk you through with real numbers so that it's completely clear. Say your business provides a car and calculating private use across the year, the taxable value comes to $10,000. Your business is registered with GST, so you apply the type 1 rate, then it comes to $20,802, then you multiply with 47%, which then becomes $9,777 in total fringe benefit tax. So the benefit was worth $10,000 and you're paying nearly the same again in tax on top of it. That's what David didn't see it coming, and that's why planning ahead matters so much. Let's talk about cars, because this is the single biggest fringe benefit tax trigger I see for most small business owners, because a lot of people want to buy cars in a company. You buy a family car or luxury car through the company and you're thinking, great, it's business asset, tax deduction, depreciation. It's all legitimate, but here's the question nobody asks upfront. How is the car actually going to be used? Because the moment there is private use, like school drop-off, weekend errands, or road trip, that private portion can trigger FBT. And it doesn't have to be a lot. Even 20 to 30% private use can generate an FBT liability that wipes out the benefit of having the vehicle in a business in the first place. Now, there are two ways ATO lets you calculate the taxable value of the benefit. It can be statutory formula method and operating cost method. The operating cost method, which requires a logbook, which can significantly reduce your FBT if your private use is quite low. But you need the records to prove it to the ATO, which brings me to one of the most costly mistakes I see. Not a lot of small business owners keep logbook with their car. When there's no record, just a car sitting in the company's name with no proper documentation of how it's used, ATO can and will assume a default level of private use. And that default is rarely in your favor as well. So before you put any vehicle in a company, ask yourself these two questions. Number one, will these cars be used privately? Or number two, am I prepared to keep a logbook for the car? Now, let's talk about two other areas where I see businesses get caught mostly: entertainment and director benefits. On entertainment, many business owners assume that if something is for business, it's automatically tax deductible and there's no further consequences. But there's a really important distinction here. Tax deductible does not really mean FBT free. Team dinners, Christmas parties, client lunches, these can all still potentially trigger FBT depending on how they are structured, who attended the event, where it happened, what was the cost, and whether it's classified as meal entertainment benefit or something else. As business grows and entertainment spending increases, this becomes one of the most expensive surprises at tax time for business owners. The structure actually matters so much, and the difference between deductible FBT-free expense and FBT liability can sometimes come down to how an event was organized as well. Now, lastly, the director benefits. This is one close to home for a lot of you watching. If your company is paying for things that are personal, your private phone bill, lifestyle costs, personal subscriptions, those can actually fall under FBT rules. And I know it can feel like I own a company, I control the company, surely I can decide what's the business expense, right? But the tax system doesn't see it that way in Australia because the company is a separate legal entity. And ATO looks at what's personal versus what's genuinely business expense. That separation is very real and it has real consequences as well. So let's quickly cover the practical side of it. Because a lot of business owners don't even know if they have FBT obligations. First, the FBT year. And like the income tax year, which runs July to June, FBT years runs from 1st of April to 31st of March. So the timing's different and the deadlines are also different. If you're providing fringe benefits, you will be required to register for FBT with the ATO record and keep detailed records throughout the financial year. Especially logbook for vehicle, you need to lodge an annual FBT return with your accountant and also pay for FBT tax liability. Even small businesses can have FBT obligations, and one of the most common mistakes I see is not registering for FBT at all because the owner simply didn't even know that they needed to. FBT is one of the most documentation sensitive areas with Australian tax. Without records, exemptions can be lost and ATO has little reason to be generous with you. Here's the good news though, FBT is quite manageable when you plan for it. A few practical things you can do right now are: 1. Review what you're running through the business, such as costs, entertainment, personal expenses, and accommodation, like I just said. Ask yourself honestly whether any of it has a private element to it. 2. Get a logbook in place for any of your company cars that you owned. A valid logbook covers you for up to 5 years if the usage pattern is quite consistent. Number 3, structure benefits correctly from the start. Some benefits can be structured or handled through employee contributions that would reduce your taxable value significantly. But this needs to be set up before the expense is used, not after. Lastly, don't miss personal and business expenses. This is the easiest way to create an FBT problem without even realizing it. Then, you should also be talking to your accountant before you make a big purchase or any big decision in your business. The time to ask, will this trigger FBT, is before you sign the contract and not after you're looking at the tax bill 12 months later like David was. So here's the big picture, okay? FBT isn't a punishment, it's a fairness mechanism built into the tax system. The ATO isn't trying to trap you, but they will collect if you're not across it. And the business owners who handle FBT well are not doing anything complicated as well. They're just asking for the right questions early, keeping clean records, and getting proper advice from the accountant before they act and not after. So ask yourself today, do I have any vehicles in my business? Do I provide any benefits or pay for personal expenses through the company? Have I ever actually reviewed my FBT exposure? If the answer to any of those is yes or maybe, it's really worth having that conversation with your accountant. If this video helped you understand FBT a little bit, hit the like button and drop your biggest question in the comments below. And don't forget to subscribe for more practical tax content made for your business owners. I'll see you in the next one. Bye for now.